Most investors use one of these two strategies, lump sum investing or DCA. Lump sum investing means simply that if you have $10,000 now, you invest $10,000 now. DCA or dollar cost averaging simply means that if you have $10,000 now, you invest, for example, $1,000 a month for the next 10 months. That's the DCA strategy. So there is a lot of discussion, and I see lots of people on YouTube saying that one is better over the other, DCA is better, talking about DCA all the time, but is DCA really the best when compared to lump sum investing? That's what I'm going to cover in this video. I'm going to show you examples, I'm showing when to do one over the other, I'm going to show you the statistics, and very importantly, I'm going to share a strategy that blends both together. And no, it's something that never crossed your mind, so stick around and I'll see you in a second. Okay, so here in the chart, what we can see is at the top we have VOO, the S&P 500 ETF, and we have the DCA strategy and the lump sum strategy. This basically simulates that whether if we were buying as VOO since March 2020, okay, and in both situations, DCA and lump sum, we have invested the same amount of money. We have invested $80,000. On the DCA strategy, we have invested $1,000 a month, okay, while in the lump sum strategy, we have invested one single time $80,000. And as you can see here, it's very clear that the lump sum strategy beat the DCA strategy. Okay, so in the lump sum strategy, we have a return of $232,000, while on the DCA, you have a return of $131,000. So $100,000 less on the DCA strategy, 131 versus 232 on the lump sum. The advantage of the DCA strategy is that it smooths out volatility. So if you have a moment of more volatility, the DCA will make it less volatile for you because in good part you have lots of cash. But that cash is not earning anything, and that's why the DCA strategy usually underperforms. In fact, there is lots of research. There is a research from Vanguard saying that 68% of the times lump sum investing beats DCA. There is a research also from Northwestern Mutual saying that 75% of the time lump sum wins. Morgan Stanley also said that in 60% of the cases lump sum wins. So why should you eventually choose DCA over lump sum? Okay, let me show you. Because if you have invested not in March 2020, but on the let's say 1st of January or February, let's say you invested February 2020. Okay, so I'm going to change here the date to February 2020. The figures will be a bit different. And why is that? Because in 2020, if you remember well, we had the COVID crash, right? We have the pandemic crash. So if you have invested right before the crash and you are investing a lump sum, it will be a bit hard on your investment. While if you are doing the DCA, now you can see here that the numbers are very different. So if you have invested lump sum and right after you have the COVID crash, you now have $174,000, okay? So, and if you have invested just at the bottom of the crash, you'll have $230,000. So it's a big difference. But this difference will be even bigger if you are using, for example, leveraged ETFs. Okay, let me load here UPRO. UPRO is a 3x S&P 500 ETF, one of my favorite ETFs. Okay, I love UPRO for long-term investing, yes, and I have a full course, 4 hours long, in my Henry Qualls Academy. Check the link in the description. But anyway, with UPRO, the story will be very different. Look at this. If you have invested right at the top of the market in 2020, now you'll have $278,000. But if you have invested just a few months later, after the market crash, you'll have over $1 million. That's what we call also path dependency. When you are investing in leverage ETFs, kind of matters when you invest, because if you invest in leverage, no matter if that leverage is the optimal leverage, you can check this indicator that I have on TradingView. my Kelly optimal leverage, and that says that the optimal leverage for the S&P 500 is 3x leverage. But of course, it's 3x leverage if there is no crash tomorrow, okay? So how can you go around this, and what should you do? Well, you should probably do a blend of both the DCA and the lump sum strategy. And the way I do it is I invest 100% of my capital. I'm always invested. But if there is a market dip, if there are opportunities to buy, because I don't know, we have, for example, also in 2022, we have the market downturn here, right? This is 2022, the market went down. This is the Trump tariffs, market went down. This is the Iran conflict, market went down. What I do is I don't have DCA strategy per se. I don't keep cash and then keep buying the dip. Most of the times what I do is I invest with some leverage, and there is a range of leverage that goes from 1x, so no leverage, up to 3x. And when I want to DCA because I want to buy the dip, I simply use this leverage to DCA. So let's say there is a moment where I have 1x leverage. So I buy VOO or SPY, okay? 1x leverage, so no leverage. If the market declines, I can sell a little bit of VOO and buy a little bit of UPRO, the 3x leverage. And if I have like 90% VOO and 10% UPRO, now I have a little bit more leverage on my portfolio. Maybe my overall leverage, I don't want to do the math, but it will be like, let's say 1.1, 1.2. And then I can sell a little bit more of VOO, 1x leverage, and buy a little bit more of UPRO, 3x, and increase to 1.3, 1.4, 1.5, 1.6 leverage, whatever you are comfortable with, of course. In this way, you can dollar cost averaging, but instead of using cash or even a margin accounts are dangerous. You can get margin call, you can lose everything. Instead of doing those things, you use leverage ETFs in order to increase a little bit your exposure to the market and do your DCA strategy. So in fact, this is what I teach in my community and what I teach in my leverage ETF course. Did you know that if you have invested in leverage ETFs, you could transform $10,000 or less into $1 million in a period of 10 years? That's correct. It's not wrong numbers. But I teach everything about it on my community. Anyway, and you have many people in my community, by the way, that more than doubled their investment using my strategies over the last 1 year alone. Anyway, back to the charts. What I do when we are investing with leverage ETFs is that I decrease the leverage where the market goes up and increase when the market goes down. So for example, on the way up here, I would decrease the leverage. So in fact, when the market goes up, I sell a little bit to bring my leverage down. Let's say I have 2x leverage. I sell a little bit of UPRO and buy VOO as the market goes up. If the market declines, like it declined here, I will increase my leverage. At the way up, I decrease my leverage. It goes down. This is what I was doing here. In 2022, I was buying lots of leverage ETFs. I was buying triple Q, I was buying QLD, I was buying SSO, I was buying UPRO, and I'm very happy. I'm retired in Hong Kong. In fact, I retired at the age of 39 in one of the most expensive cities in the world for some reason. Then the market goes up, okay, and imagine when the market here at the bottom, when you reach here, imagine you are at a 3x leverage. When the market goes up, it's time to start slowly decrease your leverage. So probably around here, I remember I was already maybe around 2x leverage. And the market declined and I increased my leverage to 2.5x during the Trump tariffs. And the market went up, I decreased my leverage to 2x. Then recently, during the Iran conflict, it declined, I increased like to 2.3x. In the meantime, Nasdaq and S&P 500 has been on a tear, absolutely crazy bull run. So I just trim a little bit my positions and I'm decreasing my leverage. So this way, as you can see, you are kind of blending together the DCA strategy with the lump sum strategy, because you are always invested, and when necessary, you can buy the dip. You have your firepower to buy the dip. Is not like cash that is like hanging around and losing value thanks to inflation. You are buying the dip with leverage ETFs that cannot be margin called, and they are very, very cost effective. Much more cost effective than a margin account, by the way, because margin accounts, a US dollar margin account at the moment, you need to pay probably like 5%, around 5% interest, while the leverage ETFs, the expense ratio, so how much you pay for the leverage ETF, is usually around between 0.7 to 0.95% a year. Much better than a margin account. And this allows you to, have results like this. Let me add here the VOO so you can be blown away by this comparison. Okay, let's put here just like 10 years. Okay, so from 2016 until now, 10 years, VOO will return 300%. Okay, so if you have $1,000 into VOO, now you have $4,000. Not bad, not bad. But UPRO return 1,600%. So this is a 17x return on investment. $1,000 will be $17,000 or $18,000. It's a huge difference, okay? It's a huge difference. And yeah, people will tell you, oh my God, leverage ETFs are volatile, volatility decay. Well, yes, they are volatile. But the main point here you need to understand is the math behind leverage ETFs. There is an optimal point of leverage that you can use where the volatility will not eat up your returns. And that optimal leverage is 3. I almost never have 3x leverage. I usually have like 1.5, 2x leverage, okay? So that I can play around with this leverage as I was just telling you. In this way, you will have much better returns than you have volatility. So what we call this, we call it risk-adjusted returns, and it's a measure that we use in finance. I've been investing for the last 20 years. We use these metrics to understand whether you should take that risk or not. And leverage ETFs is a risk that I like to take. Okay, if you enjoyed this video, Coco says that you should like and subscribe. Coco will really appreciate it. And okay, I'll see you next time.